conversation forward as to what is the real strategy in coping with this kind of an sell-off stroke bear market. Nilesh bhai, good morning. I hate to use the word bear market, but we are in a bear market. Point is, how do you deal with this kind of a bear market?
Thank you, Nikunj Bhai, for having me over here. Undoubtedly, we are in a market which is falling. And the only thing which works in such market is sticking to basics. This is the market where you don't run leverage position, you don't overtrade, you try to maintain your asset allocation. When markets are falling, you don't get afraid of bad news. And when market bounces back, you don't get carried away by the bounce back. In a falling market, you try to catch a falling knife. In a rising market, you take some profit out. So maintaining your asset allocation and sticking to basics will be the best option to make money in this market.
What is the best way to understand that markets which always are forward looking, they are discounting a lot of bad news? How does one figure that out? Because the news is bad. The news is out in the open. Inflation is a concern. Everybody knows that. The war is here and the war is here to stay. Everybody knows that. The point is how much of the current inflationary scenario and a hard landing setup in US is in the price.
So there are a couple of ways and there's no one right way. One is from a fundamental point of view. If markets were trading, let's say, above historical average valuations, you know that bulk of the bad news is not yet priced in. Market is working on optimism. If you are at around historical average valuation, you still know that some of the bad news is priced in, but not all the bad news. And when you start trading below historical average valuation, you know that now bulk of the bad news is getting priced in. So look at the valuation, not of the market, but of your portfolio to figure out whether bad news is priced in or not. The second thing is related to flow behavior. If you see retail HNI investors running large leverage position, if you see open interest running very high, if you see high carry being offered for rollovers in FNO, you know that people are optimistic and they have not yet factored in the bad news. On the other hand, when you find that carry is actually very low or negative, OI has come down dramatically, then you know that from a flow point of view, market is very, very light. The third thing will be also investors' behavior. If all the headlines are screaming that markets have corrected and one should stay away from the market, by and large, you know that market has bottomed out and it has discounted all the bad news. When consensus is for markets to fall or rise, market invariably gives the surprise. So combination of technical factors, fundamental factors, and psychological factors put together can give you a sense about whether bad news is discounted or not. Will this help you time the market to the perfection, capturing 18,500 top and 15,500 bottom? Answer is obviously no. You will get a sense of the direction, not the magnitude.
Good morning, Nilesh. This is Nayantara joining in. I believe you were in my city, Delhi, on Wednesday, meeting HNIs, investors, all that and the other at the Overall. And the main part of the conversation was what? Exactly what you're saying now. Can't time the market. It's the time you spend in the market. My question for you is, with all of this gloom and doom, the bad news that is coming in, the change in leadership in sectors also you're seeing, how are you preparing for the next bull run? Because that has to begin now. It's too late to start, selling out. It's too early to start buying.
So one thing in my interaction with investors and distributors over the last couple of weeks is that investors' confidence is far higher than fund managers' confidence. Normally in a market like this, we'll go and tell investors, don't worry, keep faith on long-term India growth story. Markets are volatile, but overall we will be fine. This time, investors are passing us this message. It's a cause of worry as well as sense of confidence. My feeling is that most retail and HNI investors are willing to take the volatility in stride. They have matured from their experience in 2000, 2008, as well as 2020. And clearly, in the tug of war between domestic investors versus global investors, I feel domestic investors remain fairly confident. In this kind of environment, as a fund manager, what do? Well, we don't take cash call because we are mandated to invest money into the market. Today, I have divided markets in three buckets. One, which is expensive, where valuations are still above historical averages, and either because of concentrated holding, low floating stock, or for other reasons, the valuations are really, really sky high. We are completely avoiding that sector, that segment, even though it can give us short-term performance. The other segment is stocks which are cheap. Some of them have done because they were very, very cheap and they bounced back. But we believe over a longer period of time, they are cheap for a reason and they are unlikely to deliver performance. We are focused on the middle segment of the sector or portfolio where valuations are reasonable, businesses are not leveraged. In this kind of environment of rising interest rate, leverage can make an impact. We are not willing to pay PE ratio price to vision. We are happy to pay PE ratio for price to cash flow. So no leverage, no sky high valuation, good businesses, real businesses, solid businesses, and there are ample opportunities available in the market. So we are building that kind of portfolio. One particular thing which we are watching now carefully, whether our companies have the ability to pass the price rise. We are in an inflationary environment. There is a cost push, and every company does not have ability to pass the price rise. So we are trying to build portfolio of companies which can pass the price rise to consumers and maintain or improve margin. This is broadly what we have been doing over the last couple of months.
Have you figured out why the fund managers are more pessimistic than investors? This is your own observation.
Absolutely. This is my own observation talking to thousands of investors and distributors over the last couple of weeks. The maturity shown by domestic investors this time is truly legendary. And it is because of their flow and their commitment that markets are standing where they are today.
Nilesh, but tell me, as a fund manager, do you worry that looking at all those headlines, the retail participant may actually take a U-turn? I know they haven't till now because all the data shared from AMFI, does suggest that the inflows are sticking by. But, given the kind of sharp slide and the kind of pain that the retail janta has actually faced, does it ever fear that, the DII support on which the market is actually, pinning itself on, that could turn around?
So undoubtedly, that worry always remains, and which is where we depend upon people like you and Nikunj Bhai to convey the message to the investors. I think in March 20, a lot of investors saw that their SIP returns came down dramatically. 3-year SIP returns were negative. 5-year SIP returns were lower than savings account return. And 10-year SIP returns were lower than FD return. That pain was visible. But at that point of time, you, Nikunj, and many other people kept on communicating to investors not to get worried, not to get perturbed by this sharp correction in market and continue your SIP. By the time the markets recovered, they could see that their returns were back into double digit. Today, despite correction in market, the SIP returns are still in high single digit to double digit. That March 20 experience have taught investors that in SIP, you should just continue your investments without looking at the return. And in case returns are low or negative, you should actually do SIP top up. That experience and the education imparted over so many years, I think has convinced retail investors to stay invested, ignore short-term volatility. And my feeling is that this time domestic investors will continue to use correction as an opportunity to invest.
Only thing is that 2020 and the kind of recovery that you saw after, the speed at which Nikunj we recovered after has also spoiled some retail investors. They think this time around as well we're going to come back and bounce back with the same speed. Unfortunately not.
I don't know. I firmly feel, Aisha, Nilesh bhai, you may want to come in here, that the cycles are getting much more shorter and much more sharper. It's technology, connectivity, awareness, movement of money. All of us are now experts in crude. I track the wheat prices every day. I have a comment to make on 10-year paper, which I've never done for the longest time. Forget 10-year paper, Nilesh bhai, I've started tracking the US 10-year paper these days also.
Nilesh, where have you picked up expertise in the last 6 months?
Well, I was never expert on geopolitics, especially on the Eastern Europe and Russia. Now, unfortunately or fortunately, we have to study that portion quite nicely. Second, we have also started looking at variety of data. Now, earlier, by talking about US Treasury and dot chart of Fed Reserve, apni gaadi chal jati thi. But nowadays, investors track that. So we have to track many more things to sound educated, sound knowledgeable. But the real challenge, Nikunj bhai, Ayesha over here, is that there is too much of noise. And that noise many a times is misdirecting people. When we were talking with so many brokerage companies, 90% of their investors who have opened demat accounts between March 20 to, let's say, 2021 end or beginning of 2022 have actually lost money. In a market which has gone from 7,500 to 15,500, 90% of traders stroke new account openers have lost money. They were carried away by noise, they were carried away by momentum and ended up losing money. On the other hand, people who have been invested in mutual funds, yes, their 1-year return might be negative, but there is a far better chance that they'll make money by staying invested rather than trading. And that realization is dawning up among investors, among traders, and which is where we are seeing increase in SIP flow, not only in terms of amount, but also in terms of number of investors every month.
Cut the noise, ignorance is bliss, and I completely agree with you there, Nilesh. And, having said that, even in all these negative news, there is some silver lining. You, for instance, did make that observation the other day that, one is seeing a fall of bad loans, and that's a good sign. We just dug out some data on soft commodities this morning, and there's been a considerable cool-off in soft commodities or agri-commodities from, the Russia-Ukraine wartime.
So undoubtedly, bearing crude, all other factors seems to be reasonably in favor of India. If crude moves from triple digit to double digit, then undoubtedly Indian economy will benefit. And all the headwinds which we are seeing will suddenly get converted into tailwind. So we need little bit of luck on crude pricing. And thereafter, my feeling is that our economy is in reasonably good shape. FDI have tripled over 2014 level. Economic activities are firmly above pre-pandemic level. Capacity utilization is now reaching 70%. Inflation is high, no doubt about it, but that's mainly driven by food and fuel. Food prices have started correcting. If fuel prices correct, inflation will again be below RBI's target level. The base effect of inflation next year will ensure that inflation continues to remain below RBI's target level. The FDI flows have remained strong. Monsoon is expected to be normal. Put all these things together, moment oil prices, energy prices starts coming down, economy will look in a far better shape.
On that happy note, Nilesh, we'll let you go. Thanks as always for taking the time out.
Thank you.